Silver is sitting at historic highs right now. Curious. And if you have been stacking for years, you are not just holding metal anymore. You are holding a decision, because at some point you are going to sell. Maybe not all of it, maybe just a portion. Maybe you need liquidity. Maybe you are rotating into something else. Maybe you have simply hit a number you never expected to see. And the moment you make that decision, a second question walks in right behind it. What does the government actually know about this transaction? Most silver investors have some version of an answer to that question floating in their head. They picked it up somewhere, a forum thread, a YouTube comment, something a dealer mentioned once in passing, maybe a conversation at a coin show 3 years ago. Sighs. But if you sat down right now and tried to explain with precision exactly which silver transactions trigger an IRS reporting form and which ones do not, and why the difference exists, most people could not do it. That gap is not harmless. It costs investors real money on both ends. Some people overreport. They assume the government is watching every transaction, disclose things they had no legal obligation to disclose, and voluntarily hand over information that was never required. They pay more than they owe because they are operating on fear rather than knowledge. Other people underreport. They assume that because no paperwork was generated at the point of sale, no tax obligation exists. They conflate the absence of documentation with the absence of liability. That assumption has a way of surfacing years later, and when it does, the cost is far higher than the original tax bill would have been. Both mistakes share the same root cause: confusion about how the system actually works. Today we are going to fix that. Silver is currently trading above $80 an ounce. If you acquired metal when it was trading in the 20s, you are sitting on gains that demand clarity, not guesswork. We are going to cover 5 specific categories of silver activity that do not automatically generate IRS dealer reporting forms. We are going to examine the exact logic behind each one. We are going to identify where the tax obligation lives, regardless of reporting status, and we are going to name the single action that takes every legal advantage in this discussion and converts it into a federal crime. Everything covered here draws from publicly available IRS guidance, Form 1099-B instructions, Form 8300 filing rules, and documented bullion industry compliance standards. This is educational content, not legal advice and not tax advice. For your specific situation, work with a qualified tax professional. But understanding how the system is structured is not optional when you are holding real money in real metal. Before anything else, there is one distinction you must understand. Without it, nothing that follows will land correctly. The word reporting and the word taxation are not the same thing. They are not interchangeable. They are not two ways of describing the same event. They are two entirely separate systems operating under separate rules, answering separate questions. Until that separation is clear in your mind, every piece of information about silver and taxes becomes dangerous, because it is easy to apply the logic of one system to the other and arrive at a conclusion that is completely wrong. Here is how each system works. The dealer reporting system is about visibility. It defines when a business that conducts a precious metals transaction is legally required to notify the IRS that the transaction occurred. 2 forms do most of the work here. Form 1099-B is filed by dealers when they purchase certain categories of bullion from customers in quantities or configurations that meet specific federally defined criteria. When a dealer files this form, the IRS receives a record of the transaction. That record can then be compared against what the seller reports on their own tax return. Form 8300 operates on a completely different trigger. It has nothing to do with what metal was sold or in what quantity. It exists entirely because of how a transaction was paid. Any business that receives more than $10,000 in cash or in instruments that function like cash under IRS definitions must file this form. Precious metals dealers fall under this rule the same way car dealers, jewelers, and real estate attorneys do. These 2 forms together create a picture of certain silver transactions. They give the IRS a window into specific kinds of financial activity. But here is what neither form does. Neither one creates your tax obligation. Neither one measures what you owe. Neither one generates the number you are responsible for. And critically, the absence of both forms does not mean you owe nothing. Your tax obligation comes from an entirely separate place. Physical silver is classified under the federal tax code as a collectible. When a collectible is sold at a gain, that profit is taxable. If you held the silver for more than 1 year, the long-term collectibles rate applies and it can reach as high as 28%. If you held it for less than a year, ordinary income rates apply, which can climb to 37% depending on your bracket. You calculate this yourself. You report it yourself on Schedule D when you file your federal return. The dealer does not do this for you. The dealer's paperwork, if it is generated at all, documents that a transaction happened. It says nothing about what you owe. This creates a situation that is manageable once you understand it and genuinely dangerous until you do. A silver transaction can complete with 0 reporting forms filed, no 1099-B, no 8300, and the profit from that transaction is still fully taxable. The IRS expects you to disclose it because the tax code requires it. The absence of a dealer-generated document does not reassign that responsibility to anyone else. Dealer reporting tells the IRS what it can already see. Tax law tells the IRS what you are obligated to show it. These overlap sometimes. They are never the same thing. Keep that distinction in mind through everything that follows. All 5 categories we are about to discuss are situations where dealer reporting does not activate. In every single one, your tax obligation can still exist. Category 1, holding the metal. The simplest category is also the most misunderstood, and the anxiety around it is almost entirely manufactured. The IRS does not receive notifications simply because you own silver. The federal tax code is a transaction-based system. It activates when property moves through an economic event, when it is sold, traded, or converted into cash or another asset. The act of holding silver in a home safe, a private vault, or a safe deposit box is not a taxable event. It generates no federal paperwork. It triggers no automatic government notification of any kind. There is no registry of privately held bullion in the United States. There is no annual disclosure form requiring you to report the contents of your stack. There is no accumulation threshold above which you must notify a government agency. There is no federal ceiling on how much silver an American citizen may legally own. An investor can hold 10 ounces. An investor can hold 50,000 ounces. Under current federal law, neither scenario requires a single document filed with any government body. A substantial amount of misinformation circulates online about imaginary federal monitoring programs that supposedly track private bullion holdings in real time. These programs do not exist within the current legal framework. The reporting infrastructure that does exist is built around transactions, not inventories. Think of it this way. The government does not monitor what you own. It monitors what you do with it. The moment you sell, trade, or otherwise convert your silver into an economic transaction, the situation changes. That is when reporting mechanisms can activate. That is when tax obligations begin. Until that moment, the metal is simply your property, no different in reporting terms from furniture, artwork, or a watch collection. Category 2, standard retail silver transactions below the reporting threshold. When most investors finally decide to sell, the assumption they carry into that conversation is wrong before it even begins. They assume that selling to a dealer automatically generates IRS paperwork. That is not how the system was designed, and it is not how the system works for the vast majority of retail transactions. Form 1099-B, in the precious metals context, was built to monitor institutional-scale metal movement. The framework is anchored to specific products connected to commodity futures market delivery standards, primarily the 1,000-ounce silver bar that functions as the standard delivery vehicle on the commodity exchange. These bars weigh close to 70 pounds. They are held by commercial entities, not by coin shop customers building a personal stack over a decade. The retail silver market operates on a completely different scale. 1-ounce coins, 10-ounce bars, 100-ounce bars. These are the products that fill dealer shelves and personal safes across the country. When sold in ordinary retail quantities, these transactions typically do not trigger Form 1099-B. The reporting framework was engineered to watch commodity scale activity. The typical retail stacker selling a tube of coins or a modest collection of bars operates below the floor of that system. Put this in concrete terms using current market conditions. An investor sells 100 ounces of standard retail silver bars today at $81 per ounce. The sale generates over $8,000 in proceeds. It is a meaningful transaction by any retail standard, but because of the product type and quantity, the dealer will likely complete that purchase without filing any reporting form. The money changes hands, no government paperwork is generated. And the tax obligation still exists. If those 100 ounces were originally purchased at $20 and sold today at $81, the gain is $61 per ounce. Across 100 ounces, that is $6,100 in taxable capital gains. The IRS expects that figure to appear on the investor's tax return, regardless of whether any dealer documentation was generated. Falling below the reporting threshold determines who files paperwork. It does not determine whether the gain is taxable. Category 3. American Silver Eagles. Among the specific products that sit outside the standard dealer reporting framework, the American Silver Eagle holds a particularly prominent position in the retail market and in this conversation. First issued by the United States Mint in 1986, the Silver Eagle contains 1 troy ounce of 0.999 fine silver and carries legal tender designation as a $1 coin. Its combination of government backing, guaranteed purity, and immediate market recognition has made it the dominant retail bullion coin in the American market. Millions are produced annually. It is the coin most individual investors think of first when they think of owning silver. Its position in the reporting landscape has a specific basis that investors should understand rather than simply accept as fact. When the precious metals dealer reporting framework was constructed, it was built around bullion products that existed at the time and were connected to commodity futures market delivery standards. The American Silver Eagle was introduced by the United States Mint after that foundational framework was established. Industry guidance that developed around dealer reporting obligations has not placed Eagle coins among the product categories commonly associated with 1099-B filing requirements. It is important to state this precisely because imprecision here creates real misunderstanding. The IRS has not published a formal list that explicitly names the Silver Eagle as an exempt product. What exists instead is the absence of eagles from the product categories that trigger the reporting obligation under the framework as it has been interpreted and applied across the industry. Dealers across the market have broadly treated Silver Eagle transactions as non-reportable, and that treatment reflects the structure of how existing guidance has been applied in practice. But dealer compliance behavior is not uniform, and individual dealers may maintain different internal policies. What this means practically is that most dealers processing a Silver Eagle transaction, whether it involves 50 coins or 500, will not file a 1099-B. The product category simply does not fall within the reporting framework as it has been applied. What it does not mean is that those transactions are tax-free. Walk through the numbers. An investor buys 500 Silver Eagles at $25 per coin. Total cost, $12,500. Silver rises over subsequent years. The investor sells those 500 coins. Even at a conservative price well below today's market, the proceeds substantially exceed the original purchase price. The difference between what was paid and what was received is a taxable capital gain at the collectibles rate. The dealer files nothing. The obligation does not disappear. The Eagle's position in the reporting framework creates a documentation advantage in one specific sense. The automatic dealer-side reporting channel does not activate. It creates no reduction whatsoever in what the investor owes the IRS on any resulting profit. Category 4. Non-cash payment methods. Form 8300 is triggered by something completely different from what drives 1099-B reporting. It does not care what metal was sold. It does not care how many ounces changed hands. It cares about one thing only: how the transaction was paid. Under federal anti-money laundering law, any business that receives more than $10,000 in cash or in instruments that qualify as cash equivalents in a single transaction must file Form 8300 with the IRS. Precious metals dealers are subject to this rule alongside car dealerships, jewelry stores, real estate professionals, and any other business that touches large-value cash transactions. The critical detail most investors miss is the definition of cash under this rule. Cash for purposes of Form 8300 includes physical U.S. and foreign currency, cashier's checks, money orders, bank drafts, and traveler's checks. These are instruments that function similarly to physical currency in high-value transactions. They are treated as cash equivalents because they operate in ways that resemble currency for purposes of financial privacy. What falls outside that definition is a longer list. Personal checks drawn on a bank account do not qualify as cash under Form 8300. Bank wire transfers do not qualify. ACH electronic transfers do not qualify. Credit cards, debit cards, and most modern electronic payment platforms do not qualify. The consequence of that distinction is direct. Two investors each sell $15,000 worth of silver to the same dealer on the same day. The first investor receives payment in physical currency. The dealer must file Form 8300 because the payment exceeds $10,000 in cash. The second investor receives payment by bank wire. No Form 8300 is filed. The payment method does not meet the statutory definition of cash: identical transaction size, identical dealer, same day. Two completely different reporting outcomes determined entirely by how the money moved. This is not a discovered loophole. It is the explicit definitional structure written into the form's instructions. The reporting rule was built around physical currency and instruments that function like physical currency. The modern banking infrastructure of wire transfers, electronic payments, and personal checks was constructed in a different lane that Form 8300 does not reach. One additional dimension matters here: The $10,000 threshold can apply across related transactions. If a customer makes multiple cash payments connected to the same underlying deal, those payments can be aggregated. If the combined total crosses the threshold, the reporting obligation may apply even if no individual payment exceeded it. This aggregation rule connects directly to a legal boundary we will address shortly. Category 5. Private sales between individuals. The fifth category rests on a structural point that is straightforward once you understand how the reporting system is organized. Form 1099-B is a business obligation. Form 8300 is a business obligation. Both forms exist because a licensed dealer or commercial entity is operating as the transacting party and carries a legal responsibility to file documentation when specific conditions are met. When silver is sold directly between two private individuals, with no licensed dealer acting as the intermediary, the automatic dealer reporting mechanisms generally do not activate. There is no business on one side of the transaction that is required to file 1099-B. There is no commercial entity subject to the Form 8300 cash threshold. The specific compliance infrastructure that creates dealer-side reporting visibility depends on a business being the party conducting the transaction. In a private sale, no such business exists. Person-to-person precious metals transactions have been part of the market since long before modern reporting frameworks existed. Coins changed hands at shows. Collectors transacted directly. Silver moved between individuals through private agreements. That tradition continues today and remains entirely legal. The structure is clean. An investor sells 200 ounces of silver directly to a private buyer. No dealer is involved. No entity files 1099-B because no dealer conducted the transaction. No entity files Form 8300 because no business received a cash payment exceeding $10,000. From an automatic dealer reporting standpoint, the transaction is invisible. But the tax obligation on any resulting profit does not vanish because no form was generated. If those 200 ounces were purchased at $20 and sold privately at $81, the capital gain exceeds $12,000. Federal tax law requires that gain to be disclosed on the investor's return. The absence of a third-party reporting document does not transfer that obligation to anyone else or eliminate it. One additional reality deserves mention here. Even when no dealer reporting form is generated, financial transactions create records through other channels. A bank wire leaves traces in the banking system. A large check is logged. A substantial cash deposit draws attention under bank compliance frameworks that operate independently of the bullion reporting system. These records are not automatically transmitted to the IRS as precious metals reports, but they become visible during audits and financial investigations. The privacy offered by a private sale means the absence of automatic dealer reporting. It has never meant the absence of any possible record, and it has never meant the absence of a tax obligation, now the boundary that cannot be crossed. Every category we have just covered is legal. Owning silver is legal. Selling in quantities below reporting thresholds is legal. Selling silver eagles is legal. Receiving payment by wire transfer is legal. Conducting private sales is legal. The architecture of these rules was not accidental. It reflects how the reporting framework was constructed, what it was designed to monitor, and what it was not designed to reach. Operating within these categories is not exploitation of a loophole. It is operating within the system as it was written. But there is one specific action that takes legal financial privacy and converts it into a federal crime. That action has a name. It is called structuring. Structuring is the deliberate fragmentation of a financial transaction, breaking a single deal into multiple smaller pieces for the explicit purpose of keeping each piece below a federal reporting threshold. The criminal element is not the size of the transaction. It is the intent behind its division. The line is clear. An investor plans to sell silver and expects to receive $15,000 in cash from a dealer. That single payment, as structured, crosses the $10,000 Form 8300 threshold. The dealer is required to file. The investor instructs the dealer to split it. $7,500 today, $7,500 next week, specifically so neither individual payment triggers the reporting form. That instruction is a federal crime. The transaction has been deliberately engineered to evade a reporting requirement, and that act by itself, regardless of whether any taxes were owed, regardless of whether any fraud was intended, constitutes a structuring offense under federal anti-money laundering statute. The penalties exist at the high end of the federal range. Individuals can face fines reaching $250,000, forfeiture of the funds involved, and imprisonment of up to 5 years. For businesses or corporations involved in structuring, maximum fines can reach $500,000 or more depending on circumstances. The most important thing to understand about this law is its independence from tax liability. An investor can sell silver at a loss, no profit, nothing owed to the IRS, zero tax obligation whatsoever, and still commit a federal structuring offense by deliberately splitting a cash payment to avoid a reporting form. The crime is the act of engineering the evasion, not the existence of a gain, not the outcome of the transaction. The decision to deliberately divide for purposes of avoiding the threshold is the offense. Precious metals dealers are trained to recognize this pattern. Their compliance frameworks require them to monitor customer behavior for signs of deliberate fragmentation. A customer who repeatedly transacts just below $10,000 in cash or who explicitly asks for payments to be divided may trigger a suspicious activity report. Dealers may voluntarily file Form 8300 even when a single payment technically falls below the threshold if the pattern of behavior suggests deliberate structuring. There is an important distinction to preserve here: selling different portions of a stack on separate occasions for legitimate commercial reasons, because you found different buyers at different times, because you are gradually liquidating over months, because you are making considered decisions about timing. That is normal financial behavior. It is not structuring. What separates legal conduct from a federal offense is intent. Normal transactions conducted for normal commercial reasons are legal. Transactions deliberately engineered around reporting thresholds for the purpose of avoiding those thresholds are not. Because intent is difficult to reconstruct or dispute after the fact, the cleanest approach is straightforward. Let transactions proceed normally. Let dealers follow their compliance procedures. Never instruct anyone to divide a payment for reasons connected to a reporting threshold. 3 myths that cost investors money. Myth 1. The federal reporting threshold was recently lowered to $600 or $3,000. This claim has spread aggressively online and created significant anxiety among silver investors who now believe that almost any meaningful sale generates automatic IRS paperwork. It is wrong. The $600 figure came from proposed regulatory changes affecting certain third-party payment platforms used to process business income. Services like online marketplaces and digital payment tools processing commercial transactions. Those proposals targeted commercial income flowing through those specific channels. They were not directed at precious metals. They do not alter the Form 8300 cash threshold applicable to bullion dealers. The $3,000 figure that appears in some versions of this claim typically refers to bank compliance requirements within the financial sector, not to bullion dealer reporting rules. As of today, the core federal cash reporting threshold for businesses including precious metals dealers remains $10,000. That number has not changed. Myth 2. Pre-1965 silver coins carry no capital gains tax because they are legal tender. The coins do technically carry face value. A pre-1965 quarter is a 25-cent coin under U.S. law. But the federal tax code evaluates precious metals transactions through market value, not face value. If an investor acquires pre-1965 silver coins for their metal content and sells them after prices have risen substantially, the difference between what was paid and what was received is a capital gain. The coin's original status as circulating currency does not alter the tax treatment of that gain in any way. The math makes it obvious. An investor buys $1,000 in face value of pre-1965 silver coins when the metal value prices those coins at $15,000. Silver rises. Those same coins later sell for $60,000. The taxable gain is $45,000. The legal tender designation changes nothing about that obligation. Myth 3. If no reporting form was filed, no tax is owed. This is the most dangerous claim on this list and the most direct product of the reporting versus taxation confusion we addressed at the start. The reasoning sounds internally consistent. No dealer filed a form. The IRS received no document. Therefore, no claim exists. That logic fails at every step. The United States tax system operates on a self-reporting architecture. The IRS relies on taxpayers to calculate and disclose their own income and capital gains. A dealer's silence does not transfer the investor's obligation to disclose a profit. The absence of third-party documentation does not create a legal exemption from the tax code. If silver is sold at a gain and that gain is not reported on the investor's tax return, the problem is not missing paperwork. The problem is unreported income. When that surfaces during an audit, through a bank record review, or in a financial investigation, the investor faces back taxes, interest, penalties, and in serious cases, additional legal consequences. The IRS has tools that operate independently of the bullion reporting system, including audit authority, bank reporting requirements, and data matching capabilities that can identify income flows regardless of whether a dealer ever filed a single form. All three myths point toward the same underlying error. They treat the reporting system as if it defines the tax system. It does not. They are separate. Understanding that separation is the foundation of every sound decision a silver investor makes, the one practice that protects everything. With all five categories clear, the structuring boundary established, and the myths addressed, there is one discipline that ultimately determines whether a silver investor navigates this system accurately. That discipline is documentation. In the precious metals market, record keeping is not administrative housekeeping. It is the financial foundation your entire tax position rests on. The reason comes down to a single number: your cost basis. Your cost basis is the total amount you paid to acquire the metal. When silver is sold, the taxable gain is calculated by subtracting that cost basis from the sale proceeds. The larger your documented and defensible cost basis, the smaller the taxable gain. Every dollar of cost basis you can prove is a dollar of gain you do not pay taxes on. Without documentation, that calculation becomes a problem. If an investor cannot prove what they originally paid for their silver, the IRS may treat the entire sale price as taxable gain, effectively assigning a cost basis of zero. Every dollar received from the sale becomes subject to the collectibles rate, including the portion that was simply a return of the original investment. The investor does not pay taxes on profit. They pay taxes on total proceeds as if the metal cost them nothing to acquire. That outcome is not theoretical. It is what the absence of records produces. The cost basis for physical silver is also typically higher than investors remember. The spot price at acquisition is only the starting point. Dealer premiums paid at purchase are part of cost basis. Shipping and insurance costs are part of cost basis. Costs associated with storage over time may be relevant. Every legitimate cost connected to the acquisition and holding of the metal can potentially be incorporated into the basis calculation, reducing the taxable gain when the metal is eventually sold. None of that is available without records. Purchase receipts, dealer invoices, bank statements reflecting the payments, dated documentation of acquisition prices. These are not optional materials. They are the difference between paying taxes on your actual profit and paying taxes on a number the IRS assigns in the absence of your documentation. Build the records now. Maintain them through the holding period. Have them available when the metal moves. Because when silver is trading at these levels, the gains are real. The tax obligations on those gains are real. And the difference between a well-documented investor and an undocumented one is not a paperwork preference. It is a significant and entirely avoidable financial loss. Silver at $80 an ounce rewards the investors who understood the rules. Work with a qualified tax professional for your specific situation and build the documentation that protects every gain you have earned.